because in the 1970s, in the mid-1970s, the Fed thought it had inflation contained. They eased and then it shot up. So they're learning from that historical era, and they want to make sure it stays contained. So what I think they will do is they'll raise interest rates towards the 4% and then stay there. And they'll tell you that they're temporarily staying there, but they'll stay there for 3, 4, 5, 6, 7 years. We don't know. I don't think we are going back towards interest rates that are, 0%. It's just not going to happen. And same as the Fed could not get inflation when it wanted to in the previous decade, and you had CPI at 1.4, 1.5, 1.6, 1.8, couldn't get to that 2%. I think the same thing will happen this decade, but on the flip side. I think CPI will remain at 2.4, 2.5, 2.6, 2.7, no matter what they do.
Welcome to Gold Silver Pros, where you'll learn the ins and outs of the gold and silver markets. Searching for the best precious metals deal? Our affiliates are of the utmost trust, quality, and highest customer service in the industry. Shop with our trusted partner, 𝙂𝙍𝙊𝙎. Access special deals on silver, gold, and platinum through our website or call 307-264-9441.
Hey everybody, this is your host, Robert Gantz with 𝙂𝙊𝙊𝙍𝙀, and I am joined by a returning guest of the program who gives us a really good outlook when he comes on about the macroeconomy, about precious metals, and about the other markets as well. It's Lior Gantz from Wealth Research Group. Lior, how are you?
I'm good. Thank you for having me back.
Yeah, so we were talking before the program about, how things are returning to normal in the real world, sort of a post-COVID or post-pandemic. And it's interesting that different parts of the world have reacted to this a little bit differently. But one thing, Lior, that everybody's paying attention to is the Federal Reserve, interest rates, the dollar, and that. Now, it's interesting to watch their comments. There seems to be some arguing among the Fed of what they want to do, but there does seem to be a very strong tone around tackling inflation. What's your view on that? What do you think the Fed is going to do going forward?
I think the Fed is trying to do two things. It's trying to convince the markets that it's not going to pivot. The reason they're trying to do that, and I'll get into why they're trying to do that. And secondly, I think that the Fed is not operating in a vacuum. All central banks are basically working towards the same thing. So first, let's talk about what they're trying to do with signaling and announcing to the market that there will be no pivot. Essentially, the Fed, and this is everything I'm telling you is exactly what Jerome Powell said in Jackson Hole in a very short and concise 10-minute lecture that I think summarized everything. And I like that. It didn't take an hour and a half to answer Q&A. It was 10 minutes, very focused. And actually, if you want my analysis, insights, and everything regarding that exact Jackson Hole speech, which is what's moving the markets for the last 3 weeks, go to wealthresearchgroup.com/ZIRP, like Z-I or ZIRP, which is the acronym for Zero Interest Rate Policy. Because here's the thing.
I'll put that up here on screen for everybody.
Exactly. Yeah, definitely. Go and definitely download that and check it out, because it's going to be way more in depth than I can answer in a short question. But here's the thing. The Fed is operating to influence 4 different types of people: households, SMB, which is small, and mid-sized businesses, the markets, and academics. That's basically the 4 types of entities that the Fed is trying to influence their behavior. They can influence behavior in 2 main ways: by announcing what they are going to do, which impacts mostly markets and academics, and then actually executing, so what I told you now is called Wall Street, and then actually doing something, executing, is households and small mid-sized business, which is Main Street. And there's also a synergy and an arbitrage, because if markets do something, they also influence Main Street by themselves. Okay, so by not capitulating and not pivoting or not getting to that imaginary threshold where they say, okay, the markets have had enough, we should, ease the throttle here, and then, expand credit again. By not doing that, by not doing what everyone anticipates and having that Fed put, that zone where they change so that the markets can expand again, they are rapidly reaching a point where inflation becomes, I wouldn't say plummeting, but definitely plateauing and starting to get into the right direction. So that's what they want. Now, what they want, ideally, is to do that with as minimal execution as possible, right? They don't want to do a Paul Volcker type move where they take interest rates to 8 or 9%. They just want to announce enough in advance so that the markets already start to behave as if it's already executed, and then you don't actually need to inflict that type of pain on everything, basically, because higher interest rates affect everything. So what I think is that we've ended the era of zero interest rate policies. The last 14 years, from 2008 till 2022, or basically, from 2009 to 2022, where interest rates were zero bound, right? That's over. What the markets thought originally was that the Fed will raise by three times, and each time will be 0.25%. That's at the beginning of 2022. That's what the market thought. Then Jamie Dimon came in and said 5 to 7. Then Goldman Sachs came in and said 7 to 9. Always, when they talk about that, they meant 0.25%. So even Goldman, which was like seen as unrealistic, we're over that. We're going towards probably 3% on the Fed funds rate in a couple of weeks here. And the 10-year bond is already at like 3.4, 3.5. So interest rates are going up a lot. And at some point, the raising interest rates more will do more damage than good. And that's where the Fed is looking for that point. And it always keeps moving. That's why every economist that you hear from will tell you that the Fed can never truly manage an interest rate hike cycle because it's always moving, and there's no right and wrong, but there's a range. They're trying to make this as painless as possible, what's called a soft landing, because if they make a big mistake, that's called a hard landing. Just because there's a plane up in the air, we're on vacation, everyone's on vacation, zero interest rates, etc. And now you need to land that plane back into reality. Okay, so the era of zero interest rates is over. Then what comes next? I think at some point they stabilize interest rates, but then what Powell said in Jackson Hole was that they want to make sure the job is done. So like my little girl, she saw like a mosquito the other day and she got freaked out, and then she smacked it, and then she like smacked it like 20 more times, even though it was dead. And so that's basically what the Fed is telling that they want to do about inflation. They want to squash it, but they want to make sure like it doesn't raise its head again. Because in the 1970s, in the mid 1970s, the Fed thought it had inflation contained. They eased, and then it shot up. So they're learning from that historical era, and they want to make sure it stays contained. So what I think they will do is they'll raise interest rates towards the 4% and then stay there. And they'll tell you that they're temporarily staying there, but they'll stay there for 3, 4, 5, 6, 7 years. We don't know. I don't think we are going back towards interest rates that are, 0%. It's just not going to happen. And same as the Fed could not get inflation when it wanted to in the previous decade, and you had CPI at 1.4, 1.5, 1.6, 1.8, couldn't get to that 2%. I think the same thing will happen this decade, but on the flip side. I think CPI will remain at 2.4, 2.5, 2.6, 2.7, no matter what they do. So I think we are entering into a very inflationary period compared to the last decade. I don't think it's going to stay at crisis mode like we are now, but I do think that they will not be able to lower interest rates. To lower CPI back to 2. I think it will remain between 2 and 3 throughout this decade, and there's a bunch of reasons for it. So that's at least the way I see it in terms of the Fed and what we need to think about. So how does it impact things? Well, for one, it's the end of TINA, right? For over a decade, you had no alternative. TINA is acronym for there is no alternatives. So there is no alternative to stocks because you had no yields in bonds and corporate bonds, etc. But I can tell you that my hedge fund manager called me like a week ago and he said, Lior, you know, I can now either buy American Airlines stock or I can lend American Airlines money at 12%. I do have a choice now. So that's why stocks are falling in price or resetting in price towards this new era where interest rates are real. Now, of course, if you lend money to the government, you're not going to make real money because you're lending them at 3.5, inflation is 8, you're losing money. But if you lend money to American Airlines, just as an example, you're making 12% even after inflation. You're making good money and definitely beating the stock market. Okay, so that's one thing. Secondly, I had a call from a real estate fund just 2 days ago. And they said, Lior, listen, we are thinking about refinancing an apartment building we bought in Manhattan. Some of the investors that we had from the original purchase in 2016, they want out. Do you want in? So I said, I do want in, but I want to buy them out at a 50% discount to whatever they paid in 2016. And they just scored me that deal. So just so you understand what's happening in real estate, if inflation is 8% and interest rates from banks are like 6%, if you want to make money in real estate, you need the yield to be like 7, 8, 9%. And for that to happen, prices need to come down or rents need to go way up. And so interest rates are like gravity. They pull everything down in price because of what's going on. And then there's this uncertainty about when the Fed is going to end this. So everyone is thinking a year ahead. They're saying, okay, why should I buy real estate now if in 1 year it's going to be cheaper? Or if I am going to buy it now, I need a buffer. I need you, the seller, to sell it to me a little lower than you think, because in 1 year, the price may be where I want it now. So I'm taking risk here. You need to come my way. And that's how this uncertainty is playing in as well. So the Fed needs to, at some point, come out and give more assurances. They need to say that they've bent the corner on inflation, that they think they're getting a handle on this so that we won't be in this very much of a crisis mode, because nobody wants to sell, nobody wants to buy. Like literally everything is frozen right now. That's where we are. So if you're asking me like, what do I think is happening? We're in this reset, global reset to the end of ZIRP, and there will be casualties, there will be victims. So you're in one of two camps. Either you're younger, like me, meaning like you're not like 2, 3, 4, 5 years from retirement, or a retiree, and so you can wait. You can be in cash for a few more months. You don't live on the income that the markets provide. Then you can wait. You can build a cash position and wait until like some sort of a true bottom is in, and then you can start building positions again. That's one school of thought. And second school of thought is, if you're a retiree, then I think that there are good opportunities out there for the first time in many years in terms of real income. You can lend money to real estate projects at 10 to 12%. You can really make money now in terms of fixed income instruments. So I do think we have that, but we are definitely, I would call where we are now a distressed time that is not a crash, but it's slowly happening. And that's even worse for many people. Because if you had a crash, you'd be like, man, this is a true crash. I should buy the dip. And you're not getting that. You're getting just a slow leaking of the air from the bubble, and that can take more and more months, and that's very frustrating to businesses, to households, because you don't, and to venture capital, you just don't know what to do because you don't know when this ends. That's why all the markets are waiting for like this flush out moment, right? But they're not getting it, and that's where I think we are.
Yeah, you brought up so much in there. We could branch this off into a bunch of different topics. You know, anecdotally, for my own situation, I've gone cash. I've gone very liquid. I am looking at apartment buildings and things in my area. Belong to a bunch of real estate investment groups that do syndications to make it easier to facilitate that. But the talk within those groups is, what about our cap rates? What about our loan to values? Because people are starting in their risk modeling to say, okay, we have higher interest rates that raises our cost of capital. At the same time, as we have inflation, it's starting to affect the affordability gap. And so what I'm doing is, whenever I am underwriting a deal, I build in risk management into my model to say, what if this happens? What if this happens? And I've done studies on different real estate markets, so I have an idea how many defaults we're going to have depending on how it goes. So I've done that research, but Lior, people are doing this and they're not diving in. I think, like you said, there seems to be this, well, if risk is up and I don't know what I'm going to get on the back end of this deal, I'm just going to hold cash and wait. And I agree with you. That's going on in real estate. It's going on in the equity markets. It's going on everywhere. And I do think that there would be deals for people, which is why I'm holding cash right now. I think that's a smart position.
Yeah.
However, I wanted to go to the bond markets for a minute. If you look, we've had the yield curve inversion. It's been inverted for almost 2 months now. We're getting to the point at which we know that's our recession, one of the best recession indicators. We had 2 consecutive quarters here in the United States of negative growth in GDP. The White House has said it's not a recession because of employment. I don't buy that argument. Do you think that this reset stage you're talking about will have to have a clean out of misallocated capital, bad credit? If so, how does that affect a lot of the markets, the stock and bond markets? I know you said we're letting the air out of the bubble. Do we need to just continue to let air out of the bubble and let it go to its next business cycle? Or is this a stage in which we need to clean out a lot of that misbegotten or misallocated capital due to those low interest rates, that zero interest rate policy we've had for so long?
Yeah, I think we're already in that. We're in that cleaning out process for sure. I can see it from the venture capital side. I can see it from the real estate side, the bond side. Definitely, we are already inside of the crash. It's just not a classic crash because we had an unprecedented event before that was already creating new circumstances in the market and everywhere. We are basically going through 3 things together. One is we went through an unprecedented health crisis that led to unprecedented government policies and central bank policies all at once. Then the response to it was very nationalized. You would think a global pandemic would have a global response, and very much, you'd see a coordination of all the nations. They would come together in the UN, and you'd have like the US leading how do we fix this? No, it was finger pointing, blaming countries, like taking different sides to it, right? Like Sweden never closing down, China closing down, like even now closing down millions of people for 2 cases. Okay. And the whole scenario of where this started from, what started it, etc. So this is a deglobalization process that you're seeing, coupled with basically a new form of living. Like, people have changed the way that they work, the way that where they want to live, what they prioritize. So a big shift in demographics and behavior. And then what I think happened is, accidentally, all of that discharged all of the inflationary potential we had, because we had that potential all the time. during the last decade. We always talked about excess credit, excess this, zero interest rate, but it just in 1 second it blew up, and then became a crisis. So now you have global shifts, deglobalization, and an inflationary crisis all at the same time. And I think what's happening right now is that you have a fourth layer, and that's when all this weakness was seized by the Russians, and they started a war in Europe. So now you also have basically a huge energy crisis in Europe that's going to take 5 to 10 years to solve. Plus, the geopolitics of Europe has changed for good. It might take, who knows, 10 to 15 years before the wounds heal from relations between Russia and Europe. And it's big. Like we're going through 4 major big things. And this is before I even talk about, the granddaddy of them all, which is Taiwan. And if you don't know what Malika is, okay, Malika, if that word doesn't ring a bell, resonate with you, if you don't understand how that part of the world is important, go to wealthresearchgroup.com/Taiwan, because you have to realize Taiwan is important. The risks are known, but Malika is such a strategic place in that area that if it's like not knowing that Polish corridor where the World War II began. It was actually that corridor that started World War II. Same thing with Malika. It could be ground zero for the conflict between China and the United States. So wealthresearchgroup.com/Taiwan for that. Definitely make sure you check that out. So, okay, so you got all these things together, and I think that they take a lot of time to unwind.
Yeah.
But there are very smart people already taking steps to solve all of this. So in general, I think we are resetting many of the things we've built our globalization on for the last 40 years and entering a new stage. But it's not negative. It's just a process, and a process like that has victims. You will have victims. You will have bankruptcies. You will have many collateral damage type events. But the idea is that on the flip side, on the other side, households will be stronger. Small and mid-sized businesses will be stronger. The markets will be more efficient. We're taking steps in the right direction. It looks like central banks, governments, and definitely corporations and capitalism are all thinking about risk right now. They're obsessing about risk, and that is a great sign that we're in the right place. Because if you only think reward, 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 that's how you get into trouble. I think everyone's obsessing about risk right now. I can see us getting into an even more distressed environment, but it's not going to be the central banks this decade that are going to create the liquidity. It's going to be the governments. So fiscal policy is going to be accommodative, while monetary policy restrictive. And you can already see that with the Inflation Reduction Act, student debt forgiveness, all of that, all these deregulations, taxation reforms, all of this is going to come in this decade, because the central banks are going to be, it's going to be very unpopular to be accommodative, because that would seem like reckless.
Yeah, it wouldn't be very populist to do that right now.
No, like for Powell to say, look, let's lower interest rates again. Politicians are gonna be like, have you lost your mind? So it's like dishing out like banker bonuses in 2009, just the most insane thing you can do from public perception. So it's not going to happen. So yeah, that's basically what we're facing, and that's big. I think the recession is started in Europe. I think Europe will be the origin of the recession, and it may trickle into the United States. Technically, yes, I understand we are in a recession, but obviously it's because you went through the biggest growth year in 50 years in 2021. So you have to like flatten these out for the averages. So yeah, we're definitely contracting, but I wouldn't say this is a classic recession. I would say it's way more of a reset than a recession.
Okay. Last question for you, and I'd like to keep you on forever because I know you do tons of research. You look around the world, and there's so many things that you and I could talk about. We could make this a marathon if we wanted. But the last question, I know that you follow investments around the world. What opportunities or what things look interesting to you right now, given all these changes going on, given geopolitical conflict? I mean, those things can be opportunities for investors. If you look around during times like this is a great place sometimes to get into stuff that could really do well. You know, what are you looking at?
For me, America is the mother lode all the time. Okay, so I love America in terms of the opportunities to get because even if you invest in U.S. corporations, they derive a lot of their revenue from outside the U.S. So for me, America is always number one. I like it. I like the rule of law. I like the rules. I like everything, the business environment, etc. I try to differentiate my investing into 5 groups, and this is I'm talking about the stock market, but this can be anything. I look for a specific few, so 2, 3, 4 companies that I think are in hyper growth mode for at least another 10 to 15 years. And the way I value them is according to what I think their market cap could be in the future as compared to now. I don't value them with traditional like P ratios and whatnot. I say to myself, this company is trying to be the number 1 in the world at this. The number 1 in the world currently has that market cap. This has 2% of that. So in my opinion, they can be 30 times bigger in 10 years. I need to be invested in that company. So I look for those 3, 4, 5 companies that can do that, that can disrupt an industry. That's one part of my portfolio. The second part of my portfolio is I like to look for companies that are world class, boring in terms of like they're not going to grow 40, 50% a year now, but they are going to grow consistently and beat the markets. So that's my second group. And I look for 5 or 6 companies in that group as well. So those are my core things to do. Those are my core position in my portfolio, those types of 10, 15 companies. And by the way, if you're subscribed to our newsletter, I keep talking about these companies that I actually own in my portfolio. And what I try and do is I try to just keep buying into them because they have a 5 to 10 year opportunity ahead of them. Aside from that, what I look for in terms of opportunities is, for me personally, I look for people that can manage my money better than I can in terms of the time they can devote to it. And that's when I get into real estate investment in things that I cannot buy on my own. Now, I'll give you an example. One fund that I'm invested in just bought the CBS building in Manhattan. Now, in a million years, I could not own the CBS building, but a fund that I am a shareholder in can, or an investor in can. So I look for specific funds that I can get involved with, and they're in the types of deals that I cannot get myself. And I like also to play broker between them and my circle. So that's how I also bring people together and open up relationships. And that's something I think everyone on this call can do, whether or not he's accredited or not. Anyone can call 10 funds, get to know the fund, get to know the people, even meet with them, and then try to bring people that just don't know about it. There are many business people exceptionally good at business, exceptionally good at what they do, have no idea how to manage their money. There's a whole slew of people, millions of people like that. They're a great lawyer. They have no idea how to invest in the stock market. They're phenomenal at opening restaurants. They don't know what to do with their capital. And you can bridge those gaps and become broker And by doing that, you become a deal maker in your area. And you can be as young as you want, as old as you want, have a lot of money. It doesn't matter. If you can do that, if you can broker these, then you become a very valuable person to both sides. And I think that's something that people need to think about in terms of opportunity. That is an opportunity. That is an opportunity. Okay. So I love doing that as well. And I think that, and I do this for fun, but I can definitely see if somebody younger were to approach me, I would say, this is what you should do. You should bring people that have money to people that have expertise and they just don't know about each other. And there's so much of that going on. You can literally hook people up all day long and become very valuable to them. They will come back to you and they will give you more opportunities, more money to manage, more deals to find them, and everything else.
I agree with you. One of the courses I recently signed up for was raising private equity, and there are a lot of laws around that in the U.S., but there's actually you can raise private equity a lot faster than you can going through, normal public market processes.
Absolutely.
And if you're the guy that does that, it's kind of like wholesaling in real estate, but you're doing it with the money instead of the deal. It's connecting people. And that's one of the things I've said for the last couple of years on my show. Your opportunities are going to be your skill sets. It's not necessarily just passive investing. I think we may be moving a little bit away from passive investing to where you get a little bit more active, or at least opportunities will be there for active investors. And it's not always you putting money out. Sometimes it's you connecting person A to person C and providing that opportunity for people. And it can be, very lucrative. So you don't necessarily have to be in the markets taking that risk. If you don't want to, sometimes you can just connect people. And we all have networks. We all have friends and family. We all have, business people we know. And I've done a lot of that just organically, connecting people with opportunities, because as you get outside of everybody just wanting to throw money into the S&P 500 and you actually have to look for opportunities, it's people that facilitate those, I think, that are going to become super valuable. So I 100% agree with that. And I'm glad that you've noticed that and are talking about it on the show, because I've noticed it and I'm trying to do that as well. All right, Lior, like I said, we could talk for hours and hours and hours. We'll definitely bring you back on the program. How do people get in contact with you? Because you do have, you do publish the things that you invest in and all of these research reports around things going around the world, tons of information. How do people sign up for that?
Yeah, wealthresearchgroup.com, and you can sign up on the homepage through the free newsletter.
Okay, thank you so much, Lior. We'll have you on again. I appreciate you.
Thank you, sir.